sponsored by the Securities and Exchange Commission of Nigeria.
Hello and welcome to Eye on Nigeria's Capital Markets. I'm Wole Famurewa and thank you for joining me. On this edition of the program, we come to you from Abuja, Nigeria at the World Pension Summit Africa Special. Nigeria is hosting the summit for the first time this year in the context of 10 years of pension reforms in Africa's largest economy. So on this edition of the program, we focus on the significant growth of Nigeria's pensions industry and what it means for the broader capital markets. Okwori Adoga Alfred is unemployed and looking for work. Since losing his job 2 years ago, finding a new job has been tough. But thanks to reforms in Nigeria's pensions industry, he can now access savings in his pension plan. Pension reforms designed to help retirees are also providing a soft landing to laid-off workers.
I work with our Service Limited. I lost my job since 2012. I could not get any job. I was struggling to get a job, but I couldn't get it. That is the aim of my coming here, to get my 25% in order to pursue my job. My former worker, I say they normally get their own from pension, but that should come to any of my pension management to get 25%, so I will be looking for my job. If I get this money, I think the money will sustain me more to get another job.
Just over a decade ago, Nigerians like Okwori faced a considerably more uncertain future. Pension schemes existed, but were often not funded as the government often failed to make pension payments to retired workers. This placed the financial footing of retirees on a very shaky foundation. Meanwhile, most private companies made little or no provision for retiring workers' pensions.
The pension liabilities must have been responsible for the reasons why government could not sell some of those government establishments. Example, NITEL. Another example, Nigeria Airways. So that's number one. Number two had to do with the fact that, people were queuing up. Pensioners were not being paid. They were dying. They've worked. They expected government to have fulfilled its own side of the obligation. Government wanted to, but there were no funds.
Prior to 2004, I think there were three broad reasons why we needed the reform. One, there was no single law codified that essentially spelled out how pension funds should be managed and supervised, and the PRA 2004 addressed that. Secondly, there was a need to look at the model we're running. We're running a pay-as-you-go defined benefit scheme, and it was broke essentially. It had about 2.7 trillion naira in deficit, and government could not finance it anymore. And it's not just a Nigerian phenomenon. All over the world, governments were moving from pay-as-you-go DB schemes to DC schemes. So there was a need to look at that. Thirdly, there was no mandatory pension requirement for private sector workers. So for those people, including myself, that have been working in the private sector for more than 10 years, we had no pensions arrangement. So there was uncertainty as to what you would do and how you would survive after retirement. So that was what the 2004 PRA sought to address.
For some of the multinationals, they got their hearts together. It was not really affecting them because they were funding, right? And it was also one of the reasons why, when we transited to this new system, some of them were allowed to operate closed pension fund or to operate approved existing schemes.
Distinguished delegates and participants.
The weakness of the pension industry was exposed when the government prepared to privatize assets in the late 1990s. Many government-owned firms had built up huge pension liabilities that threatened their sale to new investors.
The Bureau of Public Enterprises, BPE, which I headed at the time, came across huge levels of unfunded pension liabilities in many companies. The first case that really got us thinking was NITEL. We were set to privatize NITEL in 2001. And when we looked at the pension liabilities, we found that NITEL pensioners were owed accumulated liabilities of 43 billion naira. And the valuation of NITEL was not much more than 500 $500 million at the time. So we were worried that we could end up privatizing the enterprise and the entire value will go towards payment of pensions. At that time, we established that we had 2 trillion unfunded pension liabilities across the federal government. And it was scary. And we took the decision that what we needed was to introduce a defined contribution scheme that will replace the defined benefits with a transition period. And Fola's committee did a wonderful job, which was accepted by the government. And then a smaller team was constituted under his chairmanship, along with Chinelo Anohu, to go around the world and look for the best experiences in pension reforms and bring those back and reflect them in a package of reforms for pensions in Nigeria.
The problems highlighted during the government's privatization program led to extensive changes modeled after the widely regarded as successful Chilean pension reforms.
We adopted the defined contributory scheme that is portable and that allowed freedom of choice by every worker. And we adopted the Chilean model modified by the Mexican system. So it was a Chilean model, but the Mexicans are taking it to a different level. So what we adopted was Chilean model, but modified by the experience of the Mexican system.
You don't have to reinvent the wheel. Some countries, especially Latin American countries, specifically Chile, they've already moved, as far back as, 90s, moved to, defined contributory scheme. And we adopted it, with modifications, and it's very simple. On a monthly basis, your employer will contribute, you will also contribute. So it's like a mandatory compulsory savings.
The reforms in Nigeria are now also a reference point across the world. This explains why Nigeria was chosen to host the maiden edition of the World Pension Summit Africa Special.
We've reversed, the role of what government should be doing. Instead of putting the liabilities, instead of putting the responsibilities on government or the employer, we've reversed it now. Every contributor is now responsible, number one, for his choice of PFA, who is meant to manage his fund. The other thing is the fact that when you look at it, we moved from a deficit of about 2 trillion. We are not talking about a surplus pension assets of about 4.2 trillion naira. That is massive.
The pension reforms have been some of the greatest achievements of Nigeria. Because if you look back on where Nigeria was in 2004, we had what you would consider a defined benefits plan, which basically led to us having deficits that are estimated at 2.2 trillion naira, which if you use today's exchange rates would mean about $13 billion. And today, with the shift to a defined contribution system, both for the federal government employees, for private sector, we've been able to accumulate more than $27 billion. So first and foremost, that is phenomenal.
There are 31 operators. There are 20 pension fund managed administrators. There are 7 closed pension fund administrators and 4 pension fund custodians. And these, in aggregate, have employed more than 3,000 workers. So that's a significant achievement. Secondly, the pension assets have increased from less than $4 billion to $25 billion over a 10-year period. I mean, that growth has not been seen anywhere in the world within this period.
Under this new scheme, over 100,000 pensioners are collecting monthly pension. And it's beautiful to know that they don't queue up, you don't see them, because they collect in the comfort of their homes. At the right day of the month, either 19th or 28th day of the month, they are automatically credited. Their accounts are funded. So they have peace of mind. We don't have queues again. All the frauds that we've heard concerning pension are taking place, and they are related to the whole system. This new scheme has inbuilt mechanisms. No money can go out, no money can come in without the knowledge of the regulator. Right, and because you have PFAs on one side who are meant to take decisions as to how to manage the funds, You also have a separate entity. We call them the custodians. Those ones are meant to hold possession of the asset.
One must commend the initiative behind the 2004 legislation, and of course 10 years after, the need to continuously improve, and we hope that the 2014 legislation will achieve that. But pensions are perhaps a very abstract way to really describe the future of people. Really, for me, it's about people. It's about people who have given all of their productive lives. What should they look forward to 30 years down the line and all of that. And perhaps if we looked at it that way, you will understand this was the first major assignment really that I led as governor in Lagos, giving effect to the law. The law had been passed just about a month before I was elected in 2007 actually. So working with a committee of EXCO, getting the bolts and nuts into place, opening the RSAs, getting the pension fund administrators to comply with existing regulations, getting the civil servants themselves to provide their PIN numbers, and it was really brutal work, but looking back now, it was well worth it. Now we've handed that over to a fully fledged pension commission set up by the state law.
The buildup of over $27 billion in pensions assets over the last decade has not only secured the financial future of retirees, but also provided long-term funds to be deployed in a wide range of assets, essentially for economic growth and development.
40% of the Nigeria Sovereign Investment Authority assets are in the area of infrastructure, and there's a lot of scope for working together in infrastructure investments, and there's a scheme that we're working on that I think will make it easy for us to co-invest with pension funds in infrastructure. Alongside infrastructure is obviously real estate, which I think is a very important area for pension fund investments over time. But more importantly, I think, is the deepening of our capital markets is really a primary role that I think the pension fund industry will play in terms of how it makes us investable, makes us more liquid. And I expect to see conversations had about how this will over time help reduce the volatility in the capital market itself, because it's liquid and it's deep.
This is the first time, right, in the history of our financial system whereby you've got an aggregated amount of domestic savings, and it is substantial. Out of the 4.3 trillion asset under management that we are talking about for the pension industry, for now, in terms of investment guidelines, we can afford to put in place about 25% of that into listed equities. I mean, the capital market. So unlike before, whereby we have only retail domestic investors, currently we've got serious institutional and professional domestic investors. So that gives comfort. So whether we like it or not, we are influenced to a large extent, right? Liquidity on the capital market. We have influenced to a large extent because most of the foreign investors, whenever they are looking at playing on the Nigerian capital market, they always like to find out what are the domestic institutional investors doing, what are they seeing, what's their outlook for the capital market. So we are playing a role, and that role is significant.
Okay, we model the funds and the market today, and essentially we arrive at $100 billion over the next decade. If you factor in currency devaluations and potentials, maybe you could have about $80 billion. That is significant. That is outstrips whatever capacity you have today in the domestic capital market. So we think that is going to be huge in terms of new listings. Companies can come to the market and raise money. Seplar just raised $500 million. Half of that was raised locally, and PFAs bought most of that. So that's about $200 million. We're looking for new listings in oil and gas, in power, in infrastructure plays, because for listed companies, there's liquidity and entry and exit of assets.
After the break, we continue our focus on pension reforms in Nigeria and its impact on the capital markets. Over the last 10 years, reforms in Nigeria's pension sector have changed the face of a previously struggling industry. Today, over 30 fund managers and custodians are responsible for about $27 billion in assets in a new industry that employs 3,000 workers. Regulators and operators in Nigeria's capital market also highlight the contribution of the pension reforms to the broader capital market.
From a capital markets point of view, it means that we have a group of institutional investors that anchor the markets, the capital markets, from a domestic point of view, because these funds have been invested, even though very conservatively, in equities, in bonds, which are the two instruments that are prevalent in our market. So the pension fund sector has been very critical to some of what we've seen in terms of the development in the Nigerian capital markets.
Obviously, $25 billion of assets, currently 12% of that is invested in equities. And today, pension funds are the largest domestic investors in listed equities. Currently own about 4% of the market, but in terms of the free float in the market, maybe something between 15 and 20% are owned by pension funds. What we have a situation today is that we're looking for supply of quality investable equities in the market, and we're not seeing them. So, I mean, pension funds essentially have even crowded out retail domestic investors in the equity market. But even more profound and significant is in the bond market, where more than 50% of the assets are invested in bonds, particularly government bonds. We are talking about $12 billion in bonds. The Nigerian bond market, collectively, including AMCOM bonds, is just around $50 billion. So you are talking about a bond market that is very liquid today, that is tradable. I mean, today you can do trades of $2 billion on a daily basis in the bond market. There are counterparties on both sides. PFAs are largely on the buy side, and we have the banks on the other side. We also have significant offshore flows that we trade with, on the bond market.
Operators and regulators are now looking towards the future. Just before the World Pension Summit Africa Special, Nigeria's President Goodluck Jonathan signed a new law to review the 2004 Pensions Act, expected to underpin the pension industry over the next 10 years.
It introduces what you find around the world that is considered world-class, which is a multi-fund structure that responds to the different profiles of the different contributors in terms of, for example, their age profile. So younger people will tend to have a more aggressive portfolio versus those who are about to retire, who will have a less aggressive portfolio. This creates opportunities for the capital markets. But I think even more important is that with the skills that the industry has developed over the last 10 years, there's a greater recognition about the importance of not having exposure to mismatch risk, which means that your liabilities must be matched by your assets. So today, the pension fund administrators are looking at asset classes that provides them no mismatch risk, where the duration of the assets are well matched to the duration of the liabilities.
The growth in this fund will catalyze the alternative investments asset class. We are beginning to see very early steps in investing in private equity funds today, and we are looking at infrastructure assets, infrastructure fund, infrastructure bonds, and we're looking at huge significant investments that exist maybe in housing and mass housing to create mortgages for the population. One of the things that you can do and we must do for this pension system to survive is to give incentives to workers to enroll voluntarily. And one of the incentives that everybody and every worker wants to have is a house over his, a roof over his head. The other huge part we're seeing is the influx of the huge informal sector into this scheme. So we think that the pension funds can be a game changer as far as the capital markets are concerned.
In the next 10 years, we seek to consolidate what we have achieved in the past 10, but more importantly, we want to see how the contributions will impact on the contributors. That's one of the key targets for the next decade, because when you juxtapose two things, the coverage and the utilization of invested funds, and that's what we're looking to focus on in the coming years.
The reforms are also supporting the growth of new products in the capital market.
I think on the bond side specifically, we're looking at mortgage bonds, significant. We're also looking at project-specific bonds that can be traded either on OTC, on the other exchange, on the stock exchange. We're looking at asset-backed securities, whether it's just real estate or REITs, that will also create a secondary market for real estate. We are looking at housing-type bonds that will create. The housing-type bonds are different from the mortgage bonds. because the housing bonds are used to finance developers, while the mortgage bonds are used to finance mortgage banks that give loans. We're looking at infrastructure assets that are listed. We're looking at infrastructure bonds, and we're looking at infrastructure funds. On the infrastructure side, we think that the power assets over the next 5 years, once they get through this issue of gas, project financing, and are commercially viable, I think that all of them are going to be listed because the amount of capital required to finance power is huge, and I don't see it coming from commercial banks or from private investors. So we are really excited at this point that the pension funds, and I think that it's important that the populace is a bit patient with what they expect from pension funds, because haven't done 10 years, it's time to now consolidate, sit back and say, what do we do next?
Recently, we've had quite a few applications for private equity and infrastructure funds. In fact, that's the new asset class. We have we have registered 5 private equity stroke infrastructure funds, and as you may be aware, the guidelines permit pension funds to invest part of their funds in these 2 asset classes, depending on if they are registered with SEC. So we have done that, and we expect to see some investment in those funds. Besides the private equity and infrastructure funds, we're also working on securitization. The rules have been drawn up. The rules committee has gone through it, but it's a process, and we expect that when those rules are done, that it will also be a product which pension funds would be able to invest in, thus increasing their exposure in the capital market. In addition, we've also had some Islamic funds that are kind of specialized. We have an ETF Islamic funds, which is a new thing. It's under processing, but we think it's a good thing considering that under the new pension law, it's a multifaceted scheme, and it will take care of those who particularly want their funds invested in Islamic products.
It's possible for pension funds to finance infrastructure bonds, mortgage bonds at when I say low rates, at least at par with government, bond yields, government bond yields. But we need government to come in and provide some of those other incentives, like land, like prepare projects, to make them bankable, so that the contributors on these funds can access those monies through a well-defined system. It will be a bond. It could be bonds that developers can use to build houses that are affordable but not low-cost housing. So the impact could be significant. I can't give you numbers. Today we have about 6 million contributors in the scheme, but even if we touch 10% of that, that is huge, 600,000 houses. But we should be looking at something like 1 million homes built using these pension assets in a secured manner, in a way that the pension assets are safe, which is our primary objective. The returns are comparatively high, not too high, relative to government bond yields, but more importantly, impacts the contributors directly.
We've got some ETFs now, but they are still very small in terms of size, relative to what we can do in that space. So as we discuss with all this, I will call them product manufacturers, as we discuss with them, and they can sense check our appetite, because the limits are there. The limits are there, but the utilization is 0 or next to nothing.
The reform of Nigeria's pension industry has built a retirement savings pool for over 6 million workers. It has created a strong institutional investor base in Nigeria's capital market and is supporting the development of new products for long-term investors. Looking ahead into the next 10 years, pension funds are expected to help build roads, hospitals, and other infrastructure in Africa's largest economy. They will also contribute to further development of the capital market by providing demand for new products. But most importantly, the pension reforms would improve the quality of life for workers like Okwori, as they help create a savings culture that will improve the life of retirees in a way that eases the pressure on the government and the private sector. Wole Famurewa, CNBC Africa.